All right, today we are going to talk about all things MassMutual, and we're going to have a lot of fun. We're going to focus on their whole life insurance products, but we're going to really go into a deep dive here. We're going to look at their guaranteed rates, their different variable loan interest rates, their fixed loan interest rate that's available, non-direct and direct recognition. Did you know that MassMutual actually offers both non-direct and direct recognition options to policyholders? We're going to look at their different PUA riders. We're really going to go into a deep dive with respect to the PUA flexibility. Then we're going to look at their different whole life insurance products, how to maximize the internal rate of return on whole life insurance policies, have a laser focus on the consumer. If you're interested in a policy, what are some of the advantages? If you're interested in different life insurance products or you want a whole life insurance policy that's specifically designed for cash value, how do you pick the right company? Is MassMutual a fit? What is their sweet spot? Meaning, if I'm you, if I'm going to take out a whole life insurance policy that's set up for maximum cash value, just with the knowledge that I have from the years of designing life insurance policies and talking about it all the time, what would I do? Do I fund it for a short period of time, long period of time? We're going to discuss that, how their online portal works. We're going to look at historical performance. So let's get on into it. We've got a lot to cover and we're going to have some fun. So beginning with their 2022 dividend interest rate, it is 6%, which is exactly the same as what it was in 2021. Their dividend rate was 6% in 2021, and it is 6% in 2022, has not changed at all. Now their guaranteed rates, MassMutual did a bit more than other carriers with the recent 7702 change that had occurred or has occurred in the life insurance industry. So if you have a MassMutual policy and you started it before 2022, there's a good chance that you locked in the guaranteed rate of 4%. If it was a policy you recently purchased or you recently started within the past decade or so, it's likely referred to or titled their Legacy Series product. If it's their traditional policy, you could see it read Legacy 100. What the 100 represents is the age you can pay into the policy if you wanted to. But their old products with MassMutual and really all life insurance carriers for that matter, most life insurance carriers have a guaranteed rate of 4%. Now with the recent 7702 update, MassMutual, their products are referred to as their whole life series products, and their guaranteed rates will differ. MassMutual actually did things a bit differently than most carriers in respect to their guaranteed rate, and they filed 4 different rates. You'll see the guaranteed rates, we're going to go through them in a minute, range between 2 and 3.75%, depending on the product we select. And why I say they did things a little bit different than other carriers is most companies filed 1, maybe 2 different guaranteed rates. Most companies that I've seen out there have just filed a 3% guaranteed rate. Some went with a 3% rate, then a 2% rate, and really, it doesn't make a huge difference at the end of the day, but it is interesting when you look at what they did with their product portfolio. Loan rate options. So MassMutual offers both a variable loan interest rate and a fixed loan interest rate. Now, as a policyholder, if you're considering a MassMutual policy, you do need to select the option you want up front when you first start the policy. You do check off one during the application process, but you can change that up until you actually start the policy and even 90 days after you start. But after the first 90 days pass, once you make that initial payment and you sign the policy, then you're locked into whatever interest rate you started with when you started the policy. So the variable loan rate is typically whatever the guaranteed rate is plus 1%. So let's look at the guaranteed rates and the variable loan rate floors here, I should say. So the variable loan interest rate is variable. It can adjust 1 time per year only on your policy anniversary date. It is tied to Moody's Corporate Bond Index, but there is a floor to it as well. So with respect to the floor and the guaranteed rate, if we look at their different products here, so they have about 7 core products. We've got the legacy products on the bottom, which are their older products, which are no longer available. If you have a legacy whole life product, you're locked into that 4% guaranteed rate, which is nice. But if I were to look at their whole life 100 or their whole life survivorship policy, which both the 100 represents I can pay into it up until age 100, you can do that with both of those products. The guaranteed floor, the guaranteed rate is 3.75%. What this means is if the company did not pay a dividend, which this year it's 6%, if they paid no dividends during any given year, your guaranteed floor is 3.75%. Now, back to the variable loan interest rate. Guaranteed rate plus 1%. So the variable loan rate for the Whole Life 100 product right now is 4.75%. If you were to look at Moody's Corporate Bond Index, which is the gauge that MassMutual uses to determine where their variable loan interest rate is, it's right at 3%, just a tick over 3.04% as of the day we're shooting this video, but it's below 4.75%. So where I'm going with this is even though the loan interest rate environment is below 4.75% right now, that's the lowest this product will offer with respect to the variable loan interest rate. If you were to select one of these guys, the high early cash value, Whole Life 65 product, which allows you to make premium payments up until age 65, or the 20-pay product, which allows you to pay into it for a maximum of 20 years, what do we notice here? We've got a guaranteed rate of 3% and a variable loan interest rate floor of 4%. So the floor is specifically what I'm referring to there as low as that loan rate can go. If we look at the 15-pay product, 2.5% guaranteed rate, 3.5% variable loan rate floor. See the trend here? 10-pay product, 2% guaranteed interest rate, 3% variable loan rate floor. If you have one of the old products, the same thing occurred. 4% guaranteed rate, 5% variable loan interest rate floor. That's as low as that variable loan rate can go, and that would apply to you if you are borrowing directly against your life insurance policy. You're not considering anything like a cash value collateral loan, which is a nice alternative in a low interest rate environment. But some information on the variable loan interest rates are right there. Some additional information here, or the next step I should say, the fixed loan interest rate is 6%. That's pretty simple. It's a fixed rate. If you go with the fixed rate, you're locked into that fixed rate forever, and it does not adjust. It's fixed. Now, some additional awareness here. If you select the variable loan interest rate with a MassMutual policy, your policy will be treated as a non-direct recognition policy, meaning when you take loans, the company does not recognize the fact that you borrow against it and continues to pay you the same dividend, in this case 6%, on your entire cash value, any money in cash value and what you've borrowed against the policy. If you select the fixed loan interest rate, your policy will be treated as a direct recognition policy. What this means is that the company will directly recognize the fact that you take loans against the policy. They'll still pay you a dividend on everything. However, the dividend credited to borrowed money will be different than money remaining in cash value. Let's go through an example here. What I want to touch on real quick first, as this is important, is another thing with the fixed loan interest rate, which one results in direct recognition. You also cannot add the LISR rider, which we'll touch on this a lot more later. But this is very, very important if you want to make a MassMutual policy as flexible as possible. If you select the fixed loan interest rate, LISR is not available. So that is an important piece just to be aware of there, and we'll get into more detail on that. So touching on this, if you select a MassMutual policy with the variable loan interest rate, let's assume that it's the 10-pay policy and you have a cost to borrow, or I should say a loan interest rate of 3%. If you borrow against the policy, 3% cost to borrow, where does the actual loan interest go? We do not pay it back to ourselves. It goes to the insurance company. Now, on to the non-direct recognition treatment. If I borrow against the policy, the company does not recognize, non-direct recognition, does not recognize that I take a loan against the policy. So let's assume you have a dividend interest rate of 6%, which does not mean, by the way, that your policy is growing by 6%. That may equate to a net IRR, which stands for internal rate of return of 4.5%, which will be the actual growth rate on the policy. I might see it grow by 4.5%. The dividend rate is a gross rate that is credited after the company's insurance expenses and such. I always like to mention that because it can be confusing. So, cash value, $100,000. If you don't touch the money, I don't need to borrow against it. I've got 100 grand in there. That receives a 6% dividend interest rate. That's the case with direct recognition as well. If you don't touch your money, it doesn't matter if your policy is non-direct or direct recognition, doesn't matter at all. Here's the difference. Non-direct recognition, you elect to borrow against it. You take $50,000. What happens? Non-direct recognition, the company does not recognize that you take a loan, and they pay you the same dividend interest rate on any money still in cash value, or equity, I like to refer to it as, and the outstanding loan. Another way to put it is you receive the same 6% dividend interest rate on the full $100,000. And then your cost, in this particular case, is 3%. If you have, call it the higherly cash value product, or the whole life 65 product, which has a guaranteed rate of 3% and a loan interest rate of 4%, the only difference there is your cost to borrow would be 4%. So that's the non-direct recognition. We're going to look at an example of both shortly. Let's walk through direct recognition first. If you don't touch it, you've got the 6% dividend interest rate. Now let's assume you take the same loan, $50,000. Here's what happens. One, you'll have the fixed interest rate, so 6%, that goes to the insurance company. So you've got a higher cost to borrow. Higher cost to borrow right now because the variable rate obviously is variable, so it can go up and down over time. Fixed loan interest rate at 6%. Now, direct recognition means that the company will recognize the fact that you borrow against the policy and pay a different dividend rate on your borrowed funds. Before I make a note here, what I want to add is direct recognition does not mean that a company will always lower your dividend interest rate. That's a common misunderstanding. It always depends on the insurance carrier. If you look at MassMutual, for example, they actually raise the dividend interest rate. In this case, it's right around 6.5%. I hate saying right around. I like exact and specific numbers. Why I say right around 6.5% is because MassMutual does not disclose the rate. They reserve the right to adjust it. But for the past several years now, they have increased the dividend interest rate on borrowed funds. So what this means is if I have $100,000 in cash value, and in 10 years it's going to be worth $200,000, but I go through this exercise, I borrow $50,000, I pay it back, let's assume in 10 years, where it was going to be worth $200,000, now it may be worth $205,000 or $210,000 because I received a slightly higher crediting rate on the outstanding money. Let's take a look at that. So we've got some examples up here. We'll begin with the simple one, non-direct recognition. So anytime we look at policy loans, I love to compare what the policy looks like first when I just pump money into it, let it sit and grow, and then take that exact same policy and compare it side by side with the loan model. So here, we've got a growth model, age 40 male, variable loan interest rate. The actual loan interest rate over here, just over 3%. So here we modeled their 10-pay product. The loan interest rate as of today, the end of January, is just over 3%, 3.04%. But before we look at that, let's validate the design, as we always want to do. 100K per year for 10 years. What do you notice here? Year one, 100,000 goes in. Oddball death benefit, $1.49 million. Where I came up with that number is that gives us a MEC limit of, guess what? Just over 100K. So that's the minimum death benefit possible in order to have the ability to pay up to $100,000 per year. Keep in mind I said ability, not commitment. Now, as we look at this, year one, he's got 89.5, just about 90% of what he's paid in, continues to pay 100K per year in. Year four, there's my break-even point. You'll notice two columns here with IRR, annual IRR and average IRR. Both are important. I like to highlight both. If these are new to you, IRR represents internal rate of return. The annual IRR isolates what the policy is growing by year over year. So for example, if I had $100,000 and it grew to 105 that particular year, I would have an IRR of 5%. 5,000 of $100,000 is 5%. The average IRR factors in all years. A nice illustration for this is if you invest in the stock market, or if someone asked, hey, what did the S&P 500 average out over the past 30 years? I don't know, I've heard between 7 to 8%. Well, that's my average. So what's my 20-year, 30-year average? That's what the average IRR represents. Now, what's valuable about these columns is when I look at my actual cost to borrow, my loan interest rate, I can see side by side, what's my policy growing by? What am I paying in loan interest? And does it make sense? Meaning, do I have a positive spread, or am I paying more in loan interest than what I'm actually earning? Very valuable to look at that with any life insurance carrier. So here we go. What's highlighted in yellow, by the way, represents the break-even point. But the example on the right. So here, we take out a $300,000 loan in year 5. What is the impact of that policy loan? If this is your money, I'm telling you, as a licensed life insurance agent, that the insurance company is going to pay you dividends, because this is a non-direct recognition policy, dividends on any money in cash value and what's outstanding in policy loans. Like, how is that possible? That's what I would ask if I'm the consumer. That's what I did ask for quite some time when I was new in the business. So they do continue to pay you the same dividend on any money in cash value and what you've loaned. And you can see that here. Look at year 5. The annual dividend, we pulled this right from the software and illustrations like we always do. The annual dividend is $16,290. Over here in the example where we don't pull anything out, what's your annual dividend? $16,290. They're identical. So how does this benefit the insurance company? Because they have to make money, and we know that they're good at making money. Here's how. When you look at the death benefit, anytime we take a policy loan, what you will find is that your death benefit is going to be reduced by the amount you borrow. So I loaned $300,000. You'll notice that your death benefit drops by just about $300,000. So from the insurance company's perspective, think of it this way. What is the insurance company's first and foremost obligation? They are a life insurance company. It's to pay out life insurance claims. So if I'm a policyholder and I die with a loan outstanding, the company is on the hook for that much less. So number one, the death benefit's collateralized. That's a slightly lesser liability for the insurance company. Number two, there is loan interest. They're going to make money on that as well. Now they're still paying you an actual earnings rate, so that does offset itself after a certain period of time, but there is some profit that comes in there. So in this particular example, what we've got, 3.04%. Here's the loan interest, comes due. In this particular model, we assume paying the loan interest and then applying a $30,000 per year loan payment as well, loan repayment. With policy loans, you can pay it back however you want. We just did $30,000 per year. So here, when I pay it back, what do you notice? Paid back year 15. What's your cash value? $1,507,000. Non-direct recognition policy with Mass Mutual. The example to the left. When I don't touch it, I just let it sit and grow. What's your cash value? $1,507,000. What's your death benefit on both examples? They're identical as well. There's no change there, the $2.5 million. So with a non-direct recognition policy, when the loan is repaid, you'll see everything fully restored to exactly what it would have been as if you never touched it in the first place. Now, as you look at those IRRs, a lot of people have expressed this over the years, so I want to make sure that I highlight this point, is if I'm paying 3%, 3.04% in this example, isolating the annual internal rate of return, at what point in time am I actually positive? Year 5. What's a wash for that particular year? If I'm saying, okay, what did my policy grow by in policy year 5? based on the present dividend scale, 3.04%. What did I pay? 3.04%. Annually, it's better than that each year. However, when I look at the average, because I want to factor in time value of money, some people like to do that, by year 5, I've got about a 1% internal rate of return, meaning I've paid in $500,000, I've got $515 total over that 5-year span, 3.04%. It's not really until when I look at the average between years 10 and 11 here, I'm sorry, 9 and 10, where the average internal rate of return exceeds the cost to borrow, and that is a variable rate. It's just good to be aware of the stuff I found. People appreciate when we show it up front. So that is non-direct recognition. A lot of info there. I wanted to add some extra stuff, but going back to direct recognition, just to recap that, what was the difference there? The company directly recognizes the fact that we borrow against the policy, and with MassMutual, they're going to credit a higher dividend rate on borrowed funds. How on earth does that work? Let's take a look here. So, direct recognition, here we go. Same policy here. If you want to rewind a little bit, you'll notice that the growth model is identical. You've got $100K per year for 10 years. And we pulled these directly from the illustration, like we always do. Direct recognition, loan and repay. Fixed interest rate at 6% here. So we have a higher cost to borrow, but you also have the guarantee that it will never go above 6%. So as we look at this example, design's the same, IRRs are the same, all that good stuff. Let's look at this. When do we take the first loan out, actually? Year 5. In the example where you don't touch it, what do you notice? Your cash value is $515, and your dividend that year is $16,290. In this example, first start right there. What's your dividend? That's not $16,000. It's $19,440. The dividends are higher in this example. The loan's identical at $300K. Here's why the dividends are higher. MassMutual, again, has a dividend interest rate of what? 6%. So if you have a direct recognition policy with MassMutual, what will happen here is any unborrowed cash value receives the company's dividend rate for that year. In this case, 6% flat. The funds that are borrowed receive a higher dividend rate, which right now is right around 6.5%. When I run the calculation, sometimes it comes out a little bit higher, but I'm ballparking it. My point is that it is an enhanced dividend rate. So what you'll notice here is one, when we repay it, there's your loan interest. We're paying significantly more in interest costs. Here's a repayment, same $30,000 per year. But look at this. The example where you didn't touch it, 1.507. This example, 1.532. So you see greater cash value in this particular example when it's repaid. Now, as we scroll down, we take a larger loan, in this case, $1.2 million, and you see things amplified a bit. When I say amplified, in the example where you just let it sit and grow, year 15, it's year 16, your dividend payment is $49,381 in the growth model. In this example, we take a $1.2 million policy loan, look at your dividend, almost $63,000. And the dividend, by the way, so the dividend interest rate without any loans is 6%. Whenever you see the dividend interest rate on a life insurance policy, or that dividend column, I should say, it does not reflect the guaranteed rate. So in this particular case, you've got a guaranteed rate of 2%, which means that dividend column only reflects 4%. It's not the full value, I should say, which we've got other content that goes through that. But if you're crunching the numbers like I would be testing all this stuff. I do like to mention that. But in this case, so we take that $1.2 million loan out, we pay it back. Look at the difference now. 3.1 compared to 3.3 million. So you see significantly more cash value in this example. Will this actually happen? Probably not. What I'll add as an important side note is if you go with the direct recognition option with MassMutual, you do give up a good bit of control, where MassMutual can adjust that direct recognition treatment. For example, if we were to wind the clock back to the days where MassMutual had a 7.1% dividend rate for 3 years straight, I believe that was between 2013 and 2015, could be off by a year or two. But at that point in time, if you selected their direct recognition treatment with a fixed loan interest rate, they would actually decrease the dividend on borrowed funds to a rate right around 5.5%. So my point is they can adjust it over time if we select the fixed loan interest rate and their direct recognition treatment. So a lot of info there. Hope you enjoyed that piece. Let's keep on going here. Fun stuff, right? A lot to it that had to do with the loan features. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.